All right, so let's get started with the first conversation. And like I said, it's going to focus on fixed income and specifically on the bond markets here in India. What are the factors at play? Incidentally, over the last few weeks, you've seen bond yields head higher, not just in India, but in several parts of the globe. We've got Amit Tripathi, who is the Chief Investment Officer and fixed income investments at Nippon India Mutual Funds. Thank you so much, Mr. Tripathi, for taking the time. I want to start with a very basic question, and hopefully this is something that you'll be able to explain that all my viewers are going to be able to understand. A couple of weeks back, the RBI started clawing back a little bit of liquidity, but baby steps, I think, were taken. Can you explain to us how things stand right now in the domestic bond market, and what are the factors domestically that are influencing bond yields right now?
Yeah, good evening. Thanks for having me here. So essentially, there are three things that play simultaneously as we speak. On one hand, like you rightly said, we have started seeing baby steps towards the unwind of the accommodative monetary policy that we have seen for a larger part of the last 18 months. The first step, obviously, as you suggested, is a temporary drawdown of liquidity. There was humongous liquidity in the banking system that still continues to persist. Close to 11 lakh crores of core system liquidity right now. What the RBI has done in the past few weeks or past few months is to temporarily remove a portion of that liquidity through what they call as term repo auctions, whereby the RBI presents a window to banks to deposit some of this surplus liquidity with the RBI itself. And this liquidity suck out typically happens for a period of 14 to 28 days, which keeps on getting rotated again and again. So in that sense, they have been able to remove close to 6 to 7 lakh crores worth of liquidity from the system in the last 2 to 3 months. Again, just to put it in perspective, the 6 to 7 lakh crores is in the context of the 11.5 lakh crores of core system surplus that the system has. So to that extent, while some liquidity has been drawn down, a reasonable amount of surplus liquidity still exists in the system. The other thing that has been impacting the bond markets globally as well as locally has been the worry around inflation. Now, while inflation in India has still been broadly within the range which is prescribed as per the monetary policy, we are most likely end this year with an average inflation of somewhere in a range of 5.4 to 5.5. The RBI's own projection is 5.3%. But the fact is that the recent rise in commodity prices and also at a global level, the recent rise in food prices have been putting some pressure on inflation overall and core inflation specifically, including inflation related to transport. We all know where oil prices have moved up, etc., etc. So that's the other worry, which is the persistence of core inflation beyond the near term. The third aspect, obviously, is the fiscal position. But there, overall, there seems to be good news. From the start of the financial year itself, the government finances have been on a mending track. In fact, the tax collections have been very buoyant, and we might end up this year at a position which is much better than where we started the year in terms of the government fiscal position. So to that extent, yes, normalization has started. There are worries around inflation, especially core inflation, even for India. But the overall fiscal position is somewhat improving. So in that sense, it's a mixed bag. How the markets have reacted, clearly in the last 3 to 6 months, yields have hardened a bit. If you look at the shorter end of the yield curve, especially after the RBI liquidity move, the yields have moved up by 20 to 30 basis points, depending on which segment you are looking at. At the longer end, yields, in fact, in the last 3 months, barring the 10-year benchmark, I think broadly the yields are stable. More to do with the fact that the fiscal position is presenting a reasonably good picture at this
point in time. Okay. So just to try and get a sense, I'll come to where you see the yield curve moving in just a bit. But I also want to get your opinion on the taper. We were expecting it to happen, and the announcement finally has come in, and we have a roadmap as to how the taper. I'm talking about the US Fed, of course, and how that taper is going to pan out. Any implications for our markets in terms of what we need to bear in mind over the next 6 months or so?
Taper, in a sense, is about what one would expect in terms of incremental global liquidity conditions going forward, right? And to that extent, when global liquidity conditions on an incremental basis are not going to improve further and on an incremental basis are going to actually gradually come down, it does have an impact on risk assets globally. And this is not restricted to only fixed income. This is about all types of risk assets. And in fact, we discussed this in our last meeting also. As far as Indian bonds are concerned, very frankly, we don't see a direct impact of the taper coming through because domestic considerations far outweigh the movement in our bond yields, whether it is domestic considerations regarding domestic liquidity or inflation or the fiscal position. So to that extent, we don't see a direct impact coming through. But yes, in terms of the overall pricing of risk assets, does taper have an impact eventually? It does. Not directly though, or as far as domestic bond yields on a day-to-day basis.
Okay, so with that in mind, Amit, I'm going to try and get a sense from you as to how you see the entire yield curve moving. And of course, this is very hard to predict, but ceteris paribus, as they say, all things remaining as they are currently, and assuming that we don't see any major earth-shifting events over the next 6 months to a year, how do we see this panning out?
Yeah, so I'll just take some time to explain this out. So when we talk about the yield curve, we are talking about everything starting from overnight rates up to 30-year bond yields, right? So ultimately, there are two or three factors which I've already hinted at, which are at play and which are at play simultaneously. The first factor, which is the foremost factor which impacts interest rates, is the RBI policy setting. Now, we all know that the RBI was very aggressive in cutting interest rates even as we were entering the COVID period, and we were in an interest rate declining cycle even prior to that. But we have seen a sharp decline in repo rate in policy rates during the COVID period. We have seen a sharp infusion of liquidity during the COVID period. As normalization starts, we are seeing the removal of some liquidity, some excess liquidity. That will be followed by a closure of the gap between the reverse repo and the repo rate. Today it is 65 basis points. Most likely will come back to the normal 25 basis points between now and the end of this financial year. And from next year onwards, we are likely to see a slow, gradual inch up in repo rate themselves. As things stand now, we would potentially be looking at the repo rate going back to the pre-pandemic environment over the next 18 to 24 months. I want to draw attention to 2 points here. One, the RBI has been very, very clear about their focus on visibility around sustainable growth conditions. As long as the RBI feels comfortable around growth conditions sustaining, we will see this slow but normalization path going through. But they will have, like I said, equal focus on growth and inflation both. And this path, we think, starting from next financial year, will be over a period of 18 months or so. So, starting April, say 18 months or so, you could see repo rates normalizing in the 5 to 5.5% band, which today is at around 4% number. What does it do to the yield curve, this normalization? Now, what we have to understand here is that in India, the yield curve is very, very steep. What do I mean by steep? So if you look at the difference between the 10-year yield and the 1-year yield, for example, today in government bonds, that yield difference today is more than 200 basis points. In fact, it is almost closer to 240 basis points, 2.4%. Historically, that steepness has been much lesser in normal environments. So, in 2019 September, for example, prior to this entire phase, that spread was hardly 125 to 130 basis points, at max 150 basis points. So what I'm trying to highlight here is that when this RBI normalization eventually happens, we will see an impact across the yield curve, but the potential impact at the shorter end in terms of normalization will be much more, because that gets impacted much more by immediate liquidity conditions and by the RBI policy rate as compared to the longer end. So a one-year treasury bill might almost move in tandem to the extent of RBI normalization, but that does not mean that a 10-year bond or a 30-year bond will move in tandem. So ultimately, you will see rationalization in interest rates across the yield curve, but that normalization, rationalization will be much larger or much more visible at the shorter end of the yield curve as compared to the longer end of the yield curve. And last point there is that when you talk about long-term interest rates and long-term interest rate movement, apart from the policy rate set by the RBI, what the market very closely looks at is inflation expectations and the fiscal position, which is the government's borrowing position. As I mentioned, the fiscal position is already giving positive signs, which itself will support the longer end to some extent. And on inflation, there is some uncertainty still built in. There is expectation that the core inflation, which would be close to 5.75-6% this year, might still hover above 5% next year. So to that extent, the picture is slightly muddled, but it's not outrightly negative. So in that sense, we will see adjustment in interest rates. We will see adjustment in basis points more at the shorter end. The longer end look more or less balanced right now, both in terms of the comfort that people draw from the steepness of the yield curve right now, as well as the fact that the fiscal position of the government has incrementally started.
You know, you've summed it up so beautifully, Amit, and I just want to clip this and put this up right now because it's an excellent explanation of how you see the yield curve progressing. And as I understand it, you expect this flattening to take place, at least a little bit of flattening to take place starting April of next year. I have one very quick question, and this needs to be quick because we're running out of time. As we understand it, retail investors are going to be able to access the bond market very soon. What piece of advice would you give them for those of them who want to try their hands at it?
The steepness in the yield curve actually presents excellent opportunity for retail investors to go and invest across the yield curve. The only two things that they need to keep in mind, there is an aspect of price volatility that is associated with bonds as well. So please invest in maturities which are in line with your investment horizon. Don't invest in a 10-year government bond if your investment horizon is 3 months and vice versa. So as long as you invest in line with your investment horizons, you should be perfectly okay. And obviously, when you are investing in government securities, you are investing in the safest instrument that is available in Indian debt capital markets. So to that extent, you will not lose sleep. I think that this is a very good option. While this option is also available through the mutual fund platform, but direct investment obviously will boost both retail investor interest as well as volume, which is good for everyone going forward. We just hope to succeed.
I think, Amit, we're going to have to speak much more often in the coming weeks and months, considering that retail investors will, I think, be more interested in finding out more than they used to about fixed income. Of course, right now, the interest is all on equity, almost entirely. But pleasure speaking with you as always. Thank you so much for taking the time.
Thanks for having me.